Position trading in Forex. Position trading is an investment strategy where an investor holds a position in a security for a long period, ranging from weeks to years. This is in contrast to day trading or swing trading, where an investor holds a position for a short period, typically a day or a few days. In this video, we will cover everything a beginner needs to know about position trading, including its benefits, risks, strategies, and how to get started. 1. What is position trading? Position trading is a long-term investment strategy where an investor holds a position in a security for an extended period, weeks, months, or even years. The goal of position trading is to profit from the long-term upward trend of a security or market. 2. Advantages of position trading. One of the main advantages of position trading is that it allows investors to capture the long-term trend of a security, which can result in higher returns than short-term trading. Another advantage is that position trading requires less time and effort than day trading or swing trading, making it a suitable strategy for busy individuals. 3. Risks of position trading. Position trading carries some risks, such as market volatility, unexpected news events, and economic recessions. Holding a position for a long time can also result in missed opportunities, as the market can change rapidly, and the stock's price can drop significantly. 4. Position trading versus day trading and swing trading. Position trading is different from day trading and swing trading in terms of holding period and trading style. Day traders buy and sell securities within a day. Swing traders hold positions for a few days to capture short-term price movements. Position traders hold positions for weeks, months, or even years to capture long-term trends. 5. How to get started with position trading. To get started with position trading, you need to open a brokerage account and deposit funds. You should also develop a trading plan, including your investment goals, risk tolerance, and position sizing. It is essential to do your research and select stocks that fit your investment strategy. 6. Selecting stocks for position trading. When selecting stocks for position trading, you should look for companies with a strong financial position, solid earnings growth, and a competitive advantage. You should also consider the company's management, industry trends, and the overall economic outlook. 7. Position trading strategies. There are several position trading strategies, including trend following, contrarian investing, value investing, and growth investing. Trend following involves buying stocks that are trending upward, while contrarian investing involves buying stocks that are out of favor with the market. Value investing focuses on buying undervalued stocks, while growth investing focuses on buying stocks with high earnings growth potential. 8. Technical analysis for position trading. Technical analysis is a method of analyzing securities by studying charts and other technical indicators. Technical analysts use chart patterns, trend lines, and other technical indicators to identify buy and sell signals. 9. Fundamental analysis for position trading. Fundamental analysis is another method of analyzing securities that involves studying the company's financial and economic factors. Fundamental analysts study financial statements, earnings reports, and economic indicators to determine a stock's intrinsic value. 10. Risk management for position trading. Risk management is crucial in position trading, as holding a position for an extended period can expose you to market volatility and unexpected events. To manage risk, you should use stop-loss orders, diversify your portfolio, and avoid investing too much in a single stock. 11. Choosing a broker for position trading. When choosing a broker for position trading, you should consider the broker's fees, trading platform, research tools, and customer support. It is essential to select a broker that offers low fees and a user-friendly platform with advanced research tools. 12. Tax implications of position trading. Position trading has tax implications, and you should be aware of the tax rules before you start trading. Long-term capital gains are taxed at a lower rate than short-term gains, and you can also offset capital gains with capital losses. 13. Position trading in different markets. Position trading can be applied to different markets, including stocks, bonds, commodities, and Forex. Each market has its unique characteristics and requires a different approach to position trading. 14. Common mistakes to avoid in position trading. Some common mistakes to avoid in position trading include investing too much in a single stock, not diversifying your portfolio, not using stop-loss orders, and not doing your research. Position trading is a long-term investment strategy that can help investors capture the long-term trend of a security or market. It offers several advantages, such as higher returns and less time and effort than short-term trading. However, it also carries some risks, and investors should develop a sound trading plan and manage risk to succeed in trading.